So one of the negative things about the wheel strategy is that if the cost basis gets out of whack, you sell that naked put and the stock drops too much. You sell a covered call process and the stock drops too much because the wheel strategy is bullish. Selling a naked put is bullish. Selling a covered call strategy is bullish. So if it drops a lot, then that's where your cost basis gets out of whack and that becomes a problem. In this video, we're going to discuss the wheel strategy and all the good things about it. But most importantly, we're going to discuss one of the negative things about the wheel strategy. Now, let's jump right into this video. The wheel strategy is a process of selling a naked put, and then if that naked put gets assigned, meaning that you have to buy the shares, and that can be scary for a lot of people, but that is the process of how you can always get a stock at a discount. So don't be afraid of selling the naked put. You've heard of selling a cash secured put. It's the same kind of concept if you're okay with taking ownership of the shares. So with the wheel strategy, you start off by selling that naked put on a stock that you like. We're going to be looking at Apple, and we're going to talk about all the good things and then one of the bad things about trading the wheel strategy. So once again, you start off with selling the naked put, and if you have to take assignment, meaning if you have to take ownership of the stock, then you do what is called a covered call. You sell a call against your shares. So every time you sell a naked put, that represents 100 shares. So if you have to take assignment of the shares, then that means you have to buy 100 shares. And then you become what we call the landlord. You have 100 shares, and that 100 shares represents like having a house that you can rent out. You can rent it out monthly, which is traditional, or you can kind of Airbnb it out at vacation rental, do it on a daily basis, a weekly basis, a monthly basis. You determine how long you want to rent your shares out, just like you can determine how long you want to rent out a house. So you become the landlord, but it's a rent to own type of process or contract that you set up with the person who's buying the option. So you give the person the right, but not the obligation to purchase your house or your shares at a certain price. And if it doesn't meet that certain price by expiration, then the contract is over, and then you can start the process over again. It's like renting out your place once again, and they're renting it for a week, and once that week is up, then they have to rent it out again for a week, or once the month is up, they have to rent it out again for a month. You can do that same concept with selling options in the open market, which makes it pretty awesome, which makes the wheel strategy pretty awesome. But one of the problems with the wheel strategy is that once you sell the put, take ownership of the shares, and if that stock keeps falling, because that's why you had to buy the shares in the first place, because the stock was falling. When you sell that naked put, you're usually selling it out of the money, and then that stock starts falling. And if that stock falls too much, then your cost basis is out of line. Right? So your cost base is just basically how much you've paid for the underlying stock, whatever stock you're trading. Right now, we're looking at Apple. So let's just take a look at the screen here. And let's just say that Apple recently was trading almost at $200, and it's dropped to 179. You can see the price here is just above 179. So let's say that your cost basis was 189. So you are 10 points below your cost basis, or $1,000 below your cost basis. So that's a decent fall. How do you get that back? So at the Dorian Trader, we tell people that's going to happen. The wheel strategy is a bullish strategy. And so what you need to do once you had to take ownership of the shares, just sell the covered call. So in this process here, you sell the covered call, and you can get aggressive if you need to. So if your cost basis is 189, you can sell the 180 strike, just for example purposes. Say you had to take ownership and you took ownership of today, and then now you're going to do the covered call, where you can see here that if you did this covered call, you would collect $525. Well, that's going to cut your cost basis in half at that point. You're going to get closer by 50% to your cost basis. So if your cost basis was 1,000, now you're collecting 500 or 525. So you're cutting it at least in half. And then if the shares get taken away, that say Apple jumps up above 180, that's fine, right? You've executed the plan that you want to execute at this point by lowering your cost basis. And then if your shares are called away, meaning that you sell your shares away to someone at the 180, then what you do is you write down your cost basis. You know that you need to collect another $500 for example purposes. So you come in and you sell another put. You start the will strategy over again. So if you take a look at the screen here, if we sold this put at the 477, then that would represent almost a $500. So we did collect a little bit more on the call that we sold with this example. So this would basically bring you back to even if you sold the 180 here because your shares was called away for example purposes. And then if it jumps up, if the Apple continues to go up, well, you've got your monies back. If Apple drops, then you're going to have to take ownership of the shares again, and your cost base is going to change a little bit, but that's fine, right? You're back in the game, and then you can sell the cover call again. You're just trying to lower your cost basis. And one of the great things about a company like Apple is that they pay a dividend. So if you're in the shares, let's say for 3 months, 6 months, 9 months, 12 months, something such as that, you can collect a dividend as well if you own in those shares to always lower your cost basis. So one of the negative things about the will strategy is that if the cost basis gets out of whack, you sell that naked put and the stock drops too much. You sell a covered call process and the stock drops too much because the will strategy is bullish. Selling a naked put is bullish. Selling a covered call strategy is bullish. So if it drops a lot, then that's where your cost basis gets out of whack, and that becomes a problem. Obviously, the will strategy can also be a costly type of strategy, so that can be a negative to some people, but it's way better than just a buy and hold process, just buying Apple, because you're always lowering your cost basis by selling that put or selling that covered call. So you want to know this strategy. It's basic. Everyone who owns shares, at least 100 shares in a company, should understand the will strategy. At the Dorian Trader, we teach a little bit more advanced. We call it the safeguard strategy. We add 2 more strategies to this will strategy. We have other videos on that, and we encourage you to take a look at that. But what we want to get across to you today is don't be frustrated. Don't give up on the will strategy if your cost basis gets out of whack. Just keep plugging along. Keep selling puts and selling calls to lower your cost basis. And if you can get a dividend at the same time, that's great. But you will get back to even and past that if you just keep plugging along. Don't give up. It's a great strategy. It's better than a buy and hold process. All right, so thank you for watching this video. If you enjoyed it, please like and subscribe. We'll see you in the next one. Bye for now.